Back with first trades, and what's really extremely impressive in the first trades is definitely L&T. So let me take it across to Rabinder very quickly and understand what the brokerages have been saying about L&T's very mixed earnings performance.
Well, yes, it was a mixed quarter for L&T in Q1 FY27 with a revenue uptick of 7% on a yearly basis, which was largely supported by the early stage project execution, although growth was impacted by temporary logistic constraint. And EBITDA has also declined to 3% on a yearly basis, while margin came under pressure due to slower execution, project execution and higher expected credit loss provision. And on the positive side, order inflow remained robust within 14% on a yearly basis, and the company's order book also touched a record high of 7.79 lakh crore with an uptick of 27% on a yearly basis. And in the con call, management said that the Middle East projects largely remain on track, as most projects are currently in engineering and fabrication stage, and the company also reiterated its FY27 guidance and expecting 10 to 12% growth in both revenue and order inflow, and projects and manufacturing EBITDA margins of around 7.8%. And after that, brokerages have also remained constructive on the L&T, with Motilal Oswal has maintained their buy rating with target price rupees 4,550. They said that the L&T delivered a strong EPC performance despite a challenging, and Nuvama has also maintained the hold rating with target price rupees 4,065. Nuvama noted that the Middle East disruption and supply chain bottlenecks limited revenue growth and led to a slight margin decline. Apart from this, GS has also maintained their buy rating and cut target price rupees 4,370 as compared to earlier target price rupees 4,500, and JP Morgan has also maintained the overweight rating, and Jefferies has maintained the buy rating with target price rupees 5,000.
Continue to stay with us, Rabinder, because Phoenix Mills also in focus. The numbers below street estimates, especially on the top line. Take us through those earnings and why the street is disappointed.
Well, as Phoenix Mills reported its Q1 FY27 earnings, and company reported strong growth on a yearly basis, but the financial was below the street estimate. And if we talk about the revenue growth, then revenue growth was approximately 13% on a yearly basis, which was supported by a strong demand in the retail business of the companies. And profitability has also increased to 23% on a yearly basis, which was supported by 29% increase in the other income and continued cost optimization. And if we talk about the retail business of the company, then the retail business remained the key growth drivers, with the retail consumption rising 32% on a yearly basis ahead of the expectation. Strong consumption across existing mall and higher tenant sale boosted the rental income, helping the company to deliver a double-digit revenue growth despite no new mall addition during the quarters. And commercial office portfolio has also performed well, with the lease occupancy improving to 72%. And the only weak segment was residential, where pre-sales declined to 61% on a yearly basis, and collection also fell to 48%. And this is because mainly the known launches in the quarter. And in Q4 FY26 con call, management has guided that they remain optimistic and expect sustained double-digit retail earnings growth, and office occupancy is also targeted to reach around 90%.
Okay, that's some earnings reactions which are playing out, but there's Asian Paints and Eicher Motors which are due to report their numbers. Let me take it across to Avi and find out what the ET Now poll for Eicher Motors is penciling in.
So Eicher Motors is going to come out with this Q1 FY27 numbers, and let's have a look at what we are estimating at ET Now. We are estimating the revenues to be around 6358 crore rupees, which will be a 27% increase on a year-on-year basis, with EBITDA coming in at 1520 crore rupees. What is important are the margins coming in at 23.9%, which will be flattish on a yearly basis and a 1% decline on a sequential basis. The profits are expected to come at around 1400 crore rupees. The volumes for Royal Enfield are expected to be in the range of 330,000 units for the quarter gone by. Some of the factors are at play is that the Royal Enfield domestic volumes have grown very strongly on a yearly basis, but the export markets have remained softish. The price hikes that the company has taken has helped the realizations for the company, but the commodity cost inflation might impact the margins. So margins is something that will be on the cards for the investors to watch out for. The VECV margins are also expected to be under some pressure following the commodity cost inflation, and the capacity expansion that the company is taken will help the company scale up its volume. So what are some of the things that you should look out for in the results of Q1 FY27? First one being the demand outlook, including the export demand outlook, and the margin trajectory that the company posts. So margins, whether they come in at 23.9% and whether they see an impact of commodity cost inflation or they're still able to uphold their margins, the further pricing actions that the company might take to maintain the realizations and the series of product launches that they will announce. So this is some of what we are estimating at ET now, with revenues coming in at 65 crore rupees and margins something to look out for at 23.9%, which is our estimation.
Okay, that's of course what we can expect now from Eicher Motors when it reports its numbers. But let's talk about what's really happening on Capri Global as well. And let me welcome on board the management too and talk about how their performance has been. We've got Rajesh Sharma, the MD, joining in on the show right now. Rajesh, hi, great to have you today on ET Now. Wanted to understand how your earnings performance has been like, because from what I look at it and the trend in the industry, gold loans clearly, that AUM has grown very strongly, but the collateral in custody remained broadly flat for you on a sequential basis, and the average ticket size has increased. Tell me, what's your reading of how this segment is going to be in the next few quarters? Is recent gold loan growth primarily coming in from higher gold prices and larger ticket sizes rather than customer acquisition?
Thank you. So glad to share that this is the strongest quarter reported by Capri. We reported not only improvement in the margin, but also highest ever quarterly profit of 353 crore rupees. As regards gold loan growth, if you see, our total tonnage have grown from 19 ton to 20 ton. So there is an increase of almost about 5% gold in absolute quantity. And the AUM have grown from 16,000 to 19,000 crore, where now per branch we are at about 19 crore rupees per branch, which is quite high in terms of profitability perspective, and that is reflecting in the numbers. The way look at it, the gold loan prices have fallen 4% quarter on quarter basis, and despite that, growth has been very good. So I see the informal segment demand keep coming to the formal, all these small jewelers who also do the lending. Now that market is shifting to the formalized NBFC's banking system. So I see the next 5 to 10 years, the way gold loan market is tripled. Last 4 years, the gold loan prices have already 3 times. So I see a huge demand in this side, and the way the customer experience short-term borrowing money is like coming to ATM and taking money and giving in money back whenever they have surplus. So that gives a very good tool. So we are quite bullish. In fact, we intend to add about 400 branches in this current year in the gold loan itself. So we are quite excited about lending to these small retail loans backed by gold.
Interesting. But tell me, what would be the optimal mix when it comes to the gold loan faction in the entire product mix?
So I think the way we intend to grow more branches, while other segment will also grow MSME, affordable housing, small ticket size construction finance. The gold loan will grow a little faster. So overall basis, I think some point of time in next 2 years, gold loan will be in the range about 55% or so. And other segment will be in the range about 13 to 17% each.
And, Mr. Sharma, hi, this is Harsh here. So sir, your gold loan size, I mean, you've got a very, very strong gold loan book now. I mean, nearly 20,000 crore. Just talk to us, how many branches activated? Pretty much all, I would presume.
So currently we have about 1,000 branches. Yes. And by the year end, I think we should be active by about 1,400 branches. And for us, branches means that not only real estate, but acquires right kind of a talent and right kind of a risk mechanism, then only you go. So we are going very systematically. So opening the branch means not only the branch, but a lot of other things also we do.
How do you do that? How do you manage that? People is a concern. How do you hire?
So I think branch opening is not just taking one premises, one area on the lease and then you furnish it. That is not the branch. We call it branch means where really you are able to hire the right talent, you train them, your culture, focus on the risk management, not only chasing the growth, but focusing on the yield also, because alone growth doesn't help. So you have to do a calibrated growth at a particular yield, and wherever we find the right mix of talent and who can mix in our culture, there only we open the branch. The second thing, we see where the large AUM is sitting. So suppose there is some places where already few NBFCs holding AUM of 300 crore rupees. That is the cluster you want to go, so that building AUM of 20 crore rupees in 3 years will not be a big challenge.
You've got 1,000 branches currently. How many of those have you activated your gold loan product in? If you can give us that perspective, all 1,000?
So total branches of Capri about 1,430 plus, but 1,000 branches is gold loan dedicated.
You said that the gold loan mix will shift downwards now, so growth will taper, or will growth continue to remain elevated? And sorry, yes.
So gold loan mix on the book currently is about 48%, and
Correct.
that will grow to about 55%.
Okay. So you'll continue to grow on the back of gold. That is
Yes.
going to be the crucial. Okay, understood.
Yes.
And your right, please. Okay, and your LTV currently is at 70-odd%, right? No concerns
Yes.
on that count at all.
No, so earlier LTV was a little lower because gold loan prices on the rise. Now gold loan prices are on the stable basis. So we believe that new disbursement and stability basis will happen in the range about 70%. And that is quite comfortable level to have a 30% margin on the gold prices. And the gold prices, when they fall, they doesn't fall 20% in one day. So you can always originate the margin calls and keep your collection mechanism strong, either by collecting additional money or by additional gold, to make up that margin in case the prices falls.
Your ROA levers, Mr. Sharma?
So I think we have done significant progress on the cost income ratio. ROA lever will be operating scale. And with the investment in technology, data science, and now we are adopting some of the AI tools. Very soon we are going to announce a partnership with some major two AI companies also to embed the AI layer across acquisition, underwriting, collection, call centers, data. So I think efficiency is a way to drive the ROA, ROE, and we are quite confident to deliver the ROE in the range of about 19-20% and ROE in the range of about 4.5%.
Right. Okay, Mr. Sharma, always good speaking with you. Thank you for your time today.
Thank you. Thank you.
Okay, that's the word coming in from Capri Global. Very hopeful and positive on what the gold loan growth is going to look like. It's been smart, and they anticipate robust performance coming in from there till the next fiscal as well. But Netweb Technologies, that's the big buzzer in trade. It's been a blockbuster start that they have had to the fiscal. And let me take it across to Darshita and get in more commentary about what the management has to say about the visibility on growth.
Right, Netweb Technologies has started FY27 with a strong quarter, and what is impressive is that the company has delivered its highest ever quarterly revenue for Q1, which is usually the weakest quarter for the company. Now, the revenue surged 172% on a YOY basis, coming in at nearly 820 crore, while the EBITDA jumped 169% and PAT up over 180%. And more importantly, the company beat the street estimates on both revenue and profitability. Now, despite the EBITDA margins remaining broadly stable at 14.7%, this is actually above the guided range by the company of 13 to 14%, which indicates healthy execution. The management has also maintained a strong revenue growth guidance of 35 to 40% in FY27. In fact, if we see the Q1 revenue already accounts for 27% of the full year target, and the company has started the year on a strong foot. Adding to the confidence, Netweb's order book has come around 2,500 crore versus 2,100 crore same time last year. Also, the company has added 28 new customers during the quarter, ensuring the strong revenue visibility going forward.
Okay, thank you so much for that, Darshita. Now, markets looking in fine fettle, 250 points higher. So we're definitely looking much better. 24K convincingly breached this week. So that's the other piece of comfort. And IT, really, that's what's held up the market, at least for a better part of this week. But now you've got banks starting to participate. So you've got a couple of levers now, which the Nifty is relying on to push ahead. So clearly looking good this morning. But let me go across to Merrill. Paradip Phosphates, very strong June quarter. It's been record in terms of the way in which the numbers have come in. Merrill here with a breakdown of what those numbers mean. Merrill.
That's right. Absolutely an important quarter. Very good performance that we've seen in the first quarter, despite the ongoing Middle East crisis as well. So the company has seen its overall revenues grow up 36% year on year. PAT as well has seen an uptick of 25%, and volumes also for the company have increased 4% on a year-on-year basis. Now, this is the resilient performance is despite the Middle East-driven raw material volatility, which, according to the company, was aided by its strong supply chain efficiency and its diversifying sourcing of the key input materials that they use. But on the expansion front, a new very important update has come in for Paradip Phosphates. The board has also approved a 250 crore investment into its aluminium fluoride plant, which is going to be helping the company make its entry into the industrial chemical space. Now, what this is going to do is it's going to help diversify the company's overall business away from the subsidiary-linked fertilizer space and into specialty chemicals, which is also going to be helping it improve its margins going forward. So looking ahead, the company is extremely bullish on this new added segment as well, and it remains focused on delivering strong growth performance via its very strong execution and diversifying sources of raw materials as well. So the outlook on this front is also very strong.
Merrill, tell us about DCM Shriram's performance.
That's right. So we've seen an exceptional first quarter for DCM Shriram as well. Revenues have risen nearly 10% on a year-on-year basis. EBITDA also increased to 10.5%, up to 10.5% year-on-year. And the headline net profit, actually, that is the most important figure when it comes to DCM Shriram. This was seen surging to 693 crores from only 111 crores in the previous year. This was largely due to a one-time positive tax adjustment impact, which has come in at 474 crore, hitting the bottom line of the company directly. And this, adjusting for this exceptional return, the company's profits still stood at 147 crore, which is a 30% uptick on a year-on-year basis. So even adjusting for this one-time profit, it's a very good set of results that DCM Shriram has posted as well. Segment-wise, the company's agri-rural business has contributed 56% of revenues, and that continues to remain its key growth driver as well, followed by chemicals and vinyl at 34% and Fenesta building systems at 8%. And the management has also highlighted that they've seen continued resilience across its diversified portfolio given the challenging environment for the entire industry as a whole. So looking ahead, they do expect feedstock and logistics volatility due to the West Asia tensions, but they seem to be managing that execution very well, and that is why the ongoing outlook for this company as well is strong. But the main headline when it comes to DCM Shriram's figures is the exceptional rise and the uptick that we've seen in the PAT figure due to that one-off gain.
Okay, thank you so much for that, Merrill. Completely timed out on this edition of First Trades. Thank you so much, viewers, for joining in. From Eicher, myself, and everyone who puts this show together. Appreciate it.
Hello and a warm welcome. You've joined us on Midcap Masala right here on ET Now. I'm Ashesha Adwaryu. With me is Merrill D'Souza, and turning out to be a good day for Indian markets. A solid 244-point rally is what we are seeing for Indian equity markets, and several individual stocks are in focus. But this is a show where we put the spotlight on several mid-caps that are in focus. So first up, let's take you through all the top headlines that we're tracking at this hour. Paradip Phosphates jumps 8% in trade after reporting strong numbers for the first quarter. Sales volumes grew by about 4% on a year-on-year basis, which aided the solid 36% jump in revenues that the company reported. The management says that while global uncertainty is likely to persist for some more quarters, their focus on operational discipline and agile execution will continue and that the company will grow despite the volatile environment. The stock is up 9% in trade on the back of that.
That's right. Even SH Kelkar has zoomed upwards of 16% now in trade after reporting a very strong set of first quarter numbers. Revenue has jumped 14% on a year-on-year basis, supported by the healthy growth that the company has seen in its fragrance business. Now, there's also strong performance across geographies in the flavor segment, which has aided the numbers as well. And the management on Outlook, they've said that they're seeing healthy demand across key customer segments, and that their diversified portfolios is what seems to be driving broad-based growth for this company right now.
Okay, so that's SH Kelkar, but other than that, Phoenix Mills is also in focus and the stock has shed nearly 5% in trade after reporting weaker than expected first quarter results. Revenue was up 13% YOY, but it was still lower than what the street was working with. EBITDA, meanwhile, for the quarter gone by came in at 642 crores versus street expectation of about 659 crore. So across all parameters, it was a miss versus street expectations, and that is exactly why the stock is down more than 5% in trade today.
Right, that's on the real estate pack. But if we switch focus to the railway stocks, which are trading higher in trade today, Jupiter Wagons, you're seeing that counter zoom upwards of 7%. Titagarh Rail is up more than 2.5% over there. RVNL is well just climbing in trade after the company's gotten an LOA for a 360 crore order from the Eastern Central Railway. RailTel has gained upwards of 2% on winning a 44 order as well. So all of these new orders just further strengthening these companies' order book, and that's why we're seeing the strong momentum in today's trade.
And Netweb Tech, meanwhile, is gaining in trade after reporting very strong set of numbers for the first quarter of FY27. Revenue has jumped a whopping 172% on a year-on-year basis, with margins largely steady at 14.7%. The company also clocked record quarterly revenue in the first quarter, which is typically the weakest quarter, and that is exactly what justifies the kind of up move that we are seeing in the stock today.
Right, and another stock that we've got in focus today actually is Sigma Systems, where the company is bagged in upwards of 1,000 crore export order coming in from North America. Now, this order is expected to cater to 155 million base bleed artillery shells. And we have on board with us Mr. Pramod Raju, President of and Corporate Finance and Mergers and Acquisitions of Sigma Advanced, here to break that down for us. A very good morning, Mr. Raju, and thank you for joining us here at ET Now. It's a pleasure to have you on the show.
Thank you very much, Ashisha and Meryl, for having me on the show this morning.
Right, sir. So first up, let's talk about the order win. Upwards of 1,000 crores, that's 1,013 crore export order from a North American customer. Tell us more about this.
Well, thank you. We continue to focus on our defense exports market. We have our capabilities through our Naismith subsidiary. So given those relationships with the end customer, we were able to bag a $104.9 million extended range base bleed shell order, which will be executed towards the end of this year into the first half of next year. So the extended range is a new generation base bleed on the 155mm platform, which is the predominant artillery used around the world in conflicts.
Okay, so that's about the 1,013 crore order that you've won. Sir, morning, Ashesha this side, and thank you for joining us today. Does this order pave the way for many other orders that we should likely expect going forward, not only from this North American customer, but even from other global customers for that matter?
No, absolutely. Right now, the NATO markets and North America markets are highly depleted in their ammunitions. Therefore, we see great demand for continued orders to be placed, not just from this customer. And also the shift towards extended range, which is a technologically advanced capability, right? Therefore, we expect, from our progression from the filled fuses that we announced a couple of months ago to the M107 shells as well. Now we have this large base bleed extended range order. So we expect this to continue for the next few years as there is replenishment of the depleted global inventories.
Understood, Mr. Raju. Now, I want to understand where your order book position currently stands now, given that this is quite a substantial order, and you have said that how this will be margin accretive. Also, give us some sense about how much additional margin does this have, or does this bring to your company versus your normal margin range?
Sure. So let's first talk about what is our order book. This is just one of our verticals in our platform. So defense exports. We've announced the 3 orders to date, but we have our large civil aerospace demand through our Naismith operations in the UK. So that is a steady, foreseeable 7-year order book that firm order book that we see. So this will continue to add to that aerospace order book that we have. We are seeing this order to generate upper teens in our margins, right? And we expect as we get into full scale production that we will enhance that margin profile for this order book.
Okay, so that's as far as the margin profile is concerned. But let's also talk about the revenue guidance now for FY27. 1,000 crore order has now been added to your book. What will your full year guidance be for FY27 from 492 crores of revenue that you reported in FY26? What will your revenue guidance be for FY27 now?
We've been very fortunate in winning large orders, and unfortunately, we're not giving any guidance right now until our Q1 earnings results in a couple of weeks. So we do have a large, consistent order book over the next 7 years, which we'll be giving some guidance during our earnings announcements.
All right, understood, sir. Tell us this instead. Now, with 85% of your revenue coming from international markets, how is demand shaping across these markets? Can you give us some color on that?
Sure. India is quickly entering into the global supply chain of a lot of OEMs across civil aviation as well as in defense. So in this aspect, even though we are 85% of our contracts are in foreign currency, and for export, Make in India efforts that we are aggressively pursuing, it will be Make in India, right? It's just that our contracts are overseas, which have a very different program mix as well as margin mix into our earnings. What we'll continue to do is, as much as possible, manufacture that in India, right? So we are playing on the global platform. There is continued growth in the civil aviation sector as well as in the defense sector, which is the push of the government of India. So there's huge tailwinds chasing us for getting more contracts in the near term.
Okay, so that's as far as the Make in India mission is concerned, and the company says that it is focusing on making in India in line with the Make in India mission. But thank you so much for taking your time out and joining us here in ET Now and talking about the order win. The stock is up 5% yet again in trade today after the solid 5% run-up that we saw yesterday. Thank you for joining us today.
Thank you for having me.
And on that note, we need to slip into a very short break, but we'll touch base with the management of Tata Capital on the back of their strong earnings after this very short break. Welcome back. You're still tuned into Midcap Masala. And as promised, let's put the spotlight on Tata Capital, which has delivered strong June quarter, beating expectations on profit as higher fee income and better margins offset elevated provisions. Sajid spoke with Rajiv Sabharwal, MD and CEO of Tata Capital, to understand the roadmap ahead. Let's take a look.
Actually, we are present across all segments and we are seeing a good buoyancy in all segments. Obviously, the largest segment for us is housing loans, which is showing a growth of about 24%. Plus, we are seeing strong growth happening on the retail side, both on the secured and the unsecured side. SME growth is moderate, and we are seeing good growth also on the corporate side. So the vehicle segment, again, is showing good promise of growth. So the growth is well diversified, which is the good part and which we feel very good about. And that actually makes us believe that this year on growth should be very good.
Hmm. Uh, Give us a sense of the trajectory for the NIMs actually, because there's some softness that we saw in Q1 for NIMs at 5.03%. Where is this softness coming in, and can that be reversed by the end of the year?
So I'll give you a sense of all elements which go into a P&L. So growth is good. NIMs, we saw a softness there because in Q1, the cost of funds has increased. However, the way we are looking at it, it is moderating now. And we have, with our focus on increasing the proportion of high NIM products and also increasing margins on all products, we are fairly confident that the NIM will increase this year. We are also seeing significant advantage on operating efficiency. Our cost to income is down by about 190 basis points compared to Q1 of last year. And we are seeing credit costs also trending down. In fact, the slippages are much lower. So all of this makes us believe that on credit cost also this year should be very good.
The cost of borrowing went up by nearly 20 bips for you, and you're seeing that you're seeing it now trending lower. It's trending lower now. How are you countering it? Is the cost to income efficiency or operational efficiency the way to look at it?
So there are two areas on which we do believe that there is a significant upside which will happen to us over the next few quarters. One, our operating efficiency. We are seeing the advantages of the projects which we have done on GenAI coming to fore, and it translating into elements which are giving us improvement in cost to income or cost to average assets. We're seeing productivity jump in all areas. For example, just to give you a sense, our manpower just increased by 5% last year, while our AUM has grown at 22% plus. Similarly, on margins, because we are focusing on higher margin products more, and in each of the normal margin products also, we are looking at how we can increase margins. And they have, on a month-on-month basis, they have started showing a positive trend. So we are fairly confident that margins will improve this year, and operating efficiency will also see an improvement. These are the two big levers which we are focusing on to improve our ROA.
You mentioned about the fact that you're looking at high margin products, and I assume that is going into retail and SME and micro housing that will have some portion of unsecured as well. What is the strategy there for you? Therefore, for you?
So our retail unsecured forms about 10.3% of our total book, and retail unsecured as well as affordable housing, micro housing, secured business loans are some of the products which will give us more margins. And these products will grow this year by Q3, Q4 at a faster pace than the rest of the book, thus helping us increase the proportion of high margin business in our overall book. So this is how we are planning our future. But even with this increase, we do believe that our retail unsecured will remain within limits which we have set for ourselves, while they will help increase margins, but we will largely remain a secured lending business.
From the credit cost point of view, it's hitting 1% as of now. We saw a 10 bips increase in credit cost during the quarter. Do you think you have the levers to bring it down?
So we had guided for a credit cost of less than 1% by FY28. Actually, we are a year ahead on our guidance on credit cost. If you look at Q1 of last year, the credit costs were 1.6%, which are now down to 1%. So it's a 60 basis points drop there. Similarly, what happens is Q4 is usually the best quarter on credit cost. We have seen that play out with equal fervor in Q1 for all retail products. It's only in motor finance, the commercial vehicle business, that we have seen a slight uptick of 10 basis points, but that we believe is seasonal, and we should see that also trending down in the future.
How are you looking at the entire Tata Motors book, finance book, which you're trying to bring it down as well, the impact of that on the consolidated balance sheet as well? Where is that standing now, and when do you think that it will get normalized?
So we are trending very well on the transformation journey for Tata Motor Finance. We wanted to change the mix of assets. That is happening. That's progressed very well, and which is also helping us in improving our margins. We wanted to bring down our cost to income in that business. It used to be 70, it's already down to 55, and we feel there is huge potential to bring it down further. Credit costs are down in that business. I think the only place where we are now focusing on is how to increase volumes with these higher margins and lower credit costs. When I look at month-on-month numbers, they are trending well, and we should see further improvement happening in Q2 and Q3 here.
You've guided for 23 to 25% AUM growth over the medium term. Is retail, housing, and the high margin business going to be the levers for that medium term guidance that you're given?
Our biggest growth segments would be housing, retail, and SME. That will form the bulk of our business. Today also they form 85.4% of our total book. So we see good growth happening there. But while these will grow, the high margin products will grow at a faster pace than the overall book. You should start seeing this happening on our book from Q3, Q4 onwards. The disbursements on all these products are trending well, which will soon translate into a higher book growth too.
Rajiv, you have also guided for a return on asset of nearly 2.5 to 2.7 by FY28, and my assumption is that as you trend towards that guidance, you will see your NIMs also inching higher. What is the kind of NIMs targeting that you're doing as you inch towards a ROA of 2.5 to 2.8%?
If you look at the ROA in Q1 of this year and Q4 of last year, our overall ROA is 2.3%, and excluding motor finance, the ROA is 2.5%. We are seeing this path of going from 2.3 to 2.6 to 2.7 by FY28, and you will see the improvement happening with every quarter. If I have to dissect this improvement, we believe 2/3 of the improvement will happen through margin improvement, and 1/3 will happen through operating efficiency. Operating efficiency will, we are seeing clear benefits of all the Gen AI work which we have done. That is all translating into improved productivity and then into lower cost to income.
Is there a way you can also quantify this Gen AI, how it's improving your margins, in what form, or how much of margin increment came in because of the productivity increase that you have used Gen AI for?
So we are using Gen AI across the system. It's for sourcing, it's for credit assessment, it's for operations and customer service, and then also for collections. We have trained already 12,000 people within the organization on tools which they can use for using Gen AI. The whole idea being that if we can make our employees, very literate on this, then they will themselves use this and bring benefits to the organization. Just to give you a sense, 80% of all our creatives are getting made through Gen AI. When I look at our operations team, in the last 3 years, we've not added any member to that team, with our volumes almost more than doubling. So that's the benefit. If I look at productivities have increased in credit by about 40% or so. And all of this is translating into we needing less number of people to do more business. And that's a sense I was giving. We've just added about 5% to our workforce, and our book has grown by over 22%.
Interesting. Another thing which is coming out very clearly is the kind of efficiency that you're bringing in. And you also spoke about the fact that Q3 and Q4 is where you're going to see high margin business having a sizable impact on your margins. Are we to see margins hitting around 5.1% as you exit FY27?
So we are definitely looking at, for the year, a margin improvement of 10 basis points. There are many levers at play, so we are fairly confident we will get there. And if all remains well, we will try to see if we can do better. But that's the aim which we have of 10 basis points improvement.
And with that, it's a wrap on this edition of Midcap Masala. From me, Ashesha, and everyone who puts this show together. Thanks for watching. Buy Now, Sell Now is up next.